Welcome back to Smart Stock Sam, the channel where we cut through the noise and find the setups that actually matter. If you're new here, hit that subscribe button right now, because today's video is exactly why this channel exists. Because today on Smart Stock Sam, we are breaking down the full NIO picture. We're talking about the rocket fuel behind the recent rally, the technical setup screaming at us from the charts, the hidden pressure building inside the options market, a precise trade setup for the week ahead, and the long-term thesis that has one major Wall Street firm slapping a $14 price target on a stock trading in the $6 range. Here's what's coming. We cover the performance stats and the historic profitability milestone. Then we walk through the delivery explosion and the transition from burning cash to building it. We dig into the new tech and product launches, break down the analyst targets, study the technical signals, expose the short squeeze setup, and finally lay out the exact trade plan with entry targets and stop loss. Let's get into it. Look at these performance numbers and tell me this isn't a different NIO than the one critics were laughing at 18 months ago. A 13.2% surge in the short term. A massive 35% gain year to date. And before you say it, no. This is not some meme stock pump driven by Reddit hype. This rally has a foundation. NIO officially recorded its very first quarterly net profit in Q4 of 2025. Management has publicly declared that the company has entered what they're calling their third stage of development. A phase where the capital-intensive infrastructure building grind is over, and the era of scalable profitability has begun. They aren't just building cars anymore. They are finally making real money on every single one they sell. So the question every smart investor needs to ask right now is this: if the fundamental story just changed this dramatically, is the current stock price actually reflecting that new reality? We don't think so, and the chart is about to tell you exactly why. Back in February, NIO was sitting at a painful low of $4.25. Sentiment was in the gutter. Retail investors were scared. Institutional money was circling, but not yet committed. Fast forward to today, and we've seen a stunning 51% recovery, with the stock punching up to a recent high of $6.88. Now here's what most people get wrong about a move like this. When they see 51%, they think they've missed the trade. They think the easy money is gone. But history tells us the opposite. When a stock recovers this sharply on the back of a genuine fundamental shift, not hype, not a short squeeze, but real earnings news, it almost always sets a new and much higher baseline for a larger multi-year move. The V-shaped recovery you see on this chart isn't the top, it's the launching pad. And the real engine behind that launch, you'll find it in the delivery numbers. Deliveries are the single most important metric for any EV company, and NIO's delivery data right now is borderline jaw-dropping. In Q1 of 2026, NIO delivered over 83,000 units. That is a 98.3% increase year over year, essentially doubling their output in 12 months. But here's where it gets really exciting. Look at the March numbers in isolation. 35,486 vehicles delivered in a single month. That represents a 136% explosion compared to March of last year. More than double in 1 month. The star driving those numbers is the third-generation ES8, which has now held the #1 spot as the top-selling luxury EV priced above $55,000 for 4 consecutive months straight. Let me say that again. 4 months in a row, no other luxury EV in China is outselling NIO's flagship above that price point. And for investors, this matters enormously because the luxury segment is where the fat profit margins live. But here's the challenge. Can they actually turn those massive delivery volumes into sustained profitability? For years, the honest answer to that question was no. NIO was trapped in what we call the high-burn expansion phase, sinking billions into research and development, building out their now famous battery-swapping infrastructure, scaling factories, hiring engineers. Investors were patient, but they were waiting for a sign that the business model actually worked. That sign arrived in Q4 of 2025, in the form of a $16.9 million net profit. Not a forecast, not a projection, actual profit. Now, management is targeting full-year profitability for 2026, and the mechanism behind that target is a concept called volume leverage. Think of it this way. NIO has already built the factory, built the network, built the supply chain. All of that heavy lifting is done. Every additional car they sell now drops far more of its revenue straight to the bottom line. The fixed costs are absorbed, the infrastructure is paid for, the profit machine is switched on. And what comes next on the product side is going to pour fuel directly onto that machine. Let's talk technology and new launches, because this is where the story gets genuinely exciting. NIO just launched the ES9 SUV, disrupting the premium MPV market at a starting price of roughly $73,000. Strong demand out of the gate. Pre-orders have been impressive, but the real game changer, and this one almost nobody outside of deep NIO research circles is talking about, is something you can't physically see. It's a chip. NIO's own in-house developed Shenji NX 9031 chip built on 5-nanometer architecture. This is NIO's own silicon, designed by their own engineers, and its financial impact is staggering. By cutting out third-party chip suppliers and producing this technology themselves, NIO is expected to save approximately $1,381 per vehicle. Now multiply that saving by hundreds of thousands of deliveries per year, and you're looking at margin expansion that flows directly into earnings. Add one more tailwind. A new government regulation in China now exempts swappable battery vehicles from certain recycling cost burdens. That single policy change transforms NIO's battery swapping network from a cost center into a legally protected strategic moat that competitors simply cannot replicate overnight. And now, the single biggest near-term catalyst on the calendar. Mark April 21st in red on your watch list. That is the official launch date of the Onvo L90. The Onvo brand is NIO's calculated move into the mass market. A more accessible price point designed to dramatically expand their total addressable customer base. If the ES9 speaks to the ultra-luxury buyer, Onvo is NIO's answer to the everyday premium shopper. This is their Model 3 moment. They're shot at volume at scale in a segment that can genuinely move the delivery needle by another order of magnitude. Pre-launch hype is building fast, and the market is watching this date very closely. So what does Wall Street actually think this company is worth right now? Analyst sentiment has made a full 180 from skepticism to conviction. Nomura and HSBC are sitting with price targets in the $6.60 to $6.80 range, essentially current levels, making them the conservative camp. But then you look at BOCI International, and they've just reiterated a buy rating with a price target of $14. $14. That is more than 100% upside from where the stock is trading today. When you see that wide a spread between analyst targets, it almost always means the market is struggling to reprice a company that has fundamentally changed its character. If BOCI's thesis on the earnings transformation is correct, the current price isn't a stretched valuation. It's a discount window closing fast. Now let's go to the charts and let the technicals speak, because what they're saying right now is remarkably clean. We just confirmed a golden cross, the 50-day moving average crossing above the 200-day moving average. In the world of technical analysis, this is one of the most consistently reliable signals of a sustained long-term bull trend. Institutional algorithms are built to respond to this signal. But there's something even more exciting layered on top of it. A textbook cup and handle pattern is forming. The rim of that cup points directly to last year's high of $8.01. Once the handle breaks to the upside, that $8.01 level becomes the initial magnet. That is the first target on the technical map, and based on current momentum, it isn't as far away as it might look. Zoom into the momentum indicators and the picture gets even more compelling. The RSI, Relative Strength Index, is sitting at 63.78. Here's what that means in plain English. The stock has strong bullish momentum, but it is not yet in overbought territory. There is still substantial room to run before the chart flashes any kind of overheating signal. The MACD is simultaneously showing an active buy signal. And perhaps most importantly, price is currently trading above all three major moving averages: the 20-day, the 50-day, and the 200-day. In trading, we call this full structural support alignment. The floor is set. The path of least resistance is up. But here is where this story takes a turn that could genuinely accelerate everything. Let's talk about the short squeeze potential because the setup is extraordinary. There are currently 146 million shares sold short in NIO. 146 million bets that this stock goes down. The days to cover metric, which measures how many trading days it would take short sellers to buy back all those shares at current volume, stands at nearly 5 days. Now here is the critical threshold to watch. If NIO breaks through the psychological resistance level of $7, those short sellers face a crisis. They are forced to buy back their shares simultaneously to cut their losses. That forced buying creates a self-reinforcing cycle of upward price pressure, a short squeeze that can drive a stock far, far higher in a very short window. With nearly 44% of short volume happening off exchange, there is a massive reservoir of hidden pressure just waiting for the right catalyst to release. The options market is telling the exact same story. Of all the options contracts currently open on NIO, a remarkable 77% are call options, bets that the price goes higher. Only 23% are puts. That extreme skew toward calls tells us that institutional traders are not hedging for downside. They are positioning for a breakout. And when you see that level of call activity, it sets up the conditions for a gamma squeeze, where market makers, in order to hedge their own exposure on all those call contracts, are forced to buy the underlying stock, which further fuels the rally in a mechanical, almost automatic way. Looking at the depth of market, the battle lines are clear. The $7 strike price is the major resistance boss level, with nearly 30,000 contracts sitting right there. Clear that ceiling, and there is very little technical resistance until $7.50. On the downside, there are hard support floors at $5.50 and $5 even, giving us a well-defined risk-to-reward framework. Here is the trade setup in plain terms. The entry zone is between $6.60 and $6.80, targeting those small pullbacks to the 10-day moving average. Set your stop loss at $6.40 to protect against any sudden volatility. The primary target is $8.01, the cup and handle technical objective. For long-term conviction holders, the secondary target is $14, the fundamental value that BOCI International's analysis supports. Now, before we wrap up, Smart Stock Sam has an important obligation to you. Nothing in this video is financial advice. Everything discussed here is purely for educational and informational purposes. NIO carries significant risks. It is a Chinese EV company subject to geopolitical tensions, regulatory changes in both China and the United States, and the inherent volatility of the EV sector. Past performance and technical patterns are never a guarantee of future results. Always do your own research. Consult a licensed financial advisor before making any investment decisions. Never invest money you cannot afford to lose. Your capital is always at risk. With that said, here's the bottom line. NIO has grown up. The money pit is closed. The profit machine is open. Surging deliveries nearly doubling year over year. A landmark first quarterly profit. A new product cycle with the ES9 and the Onvo launch. Proprietary chip technology saving over $1,000 per vehicle, a golden cross on the chart, a ferocious short squeeze setup building behind the scenes, and one analyst firm saying this stock belongs at $14. This is not a story you walk away from without doing your homework. Watch the $7 level like a hawk. Circle April 21st for the Onvo launch. Track the Q2 margin reports closely. The data here is hard to argue with. Here's the question I want to leave you with. And I want your genuine answer in the comments below. Do you think NIO can reach $14 within the next 12 months? Or do you believe the geopolitical risks between the US and China make that target unreachable regardless of the fundamentals? Drop your price target for NIO by end of year in the comments. I read every single one, and I will be replying this week. If this breakdown gave you value, and I genuinely hope it did, please hit that like button right now. It takes 2 seconds, and it helps this channel reach more investors who need this kind of research. And if you are not yet subscribed to Smart Stock Sam, what are you waiting for? We do this every week. Deep dives, clean setups, real data, no fluff. Hit subscribe and turn on notifications so you never miss a breakdown. And if you really want to support the work we put into these videos, YouTube has a super thanks feature. Use it to show your love and support. Any contribution goes directly back into the research and production that makes Smart Stock Sam what it is. See you in the next video.